Why Gucci sales plunged 25% in Q2 2025, the Kering luxury crisis explained. In a shocking turn of events, Gucci has experienced a staggering 25% decline in sales during the second quarter, highlighting the ongoing struggles faced by its parent company, Kering. This luxury giant, known for its high-end fashion offerings, reported results that were worse than anticipated, attributing the downturn to persistent geopolitical uncertainties that continue to plague the brand. For the second quarter, Gucci's sales fell to €1.46 billion, approximately $1.6 billion, a significant drop from the previous year, which is particularly alarming given that Gucci typically accounts for nearly half of Kering's total revenue. Analysts had predicted sales of around €3.96 billion. François-Henri Pinault, the chairman and CEO of Kering, expressed disappointment over these results, but emphasized the company's commitment to making necessary adjustments to navigate through these challenging times. He stated, "While the figures we are presenting are far from our potential, we believe that the extensive efforts we have undertaken over the past 2 years has laid a solid foundation for Kering's future growth." Kering's strategy aims to achieve sustainable long-term growth despite the uncertain economic and geopolitical landscape. The company, which also owns renowned brands like Saint Laurent and Bottega Veneta, reported weaker sales across all markets, particularly in Japan and the broader Asia-Pacific region. Yanmi Tang, an analyst at Third Bridge, pointed out that Kering is grappling with a harsh reality as its primary luxury markets, China and the United States, are under significant pressure. New leadership on the horizon. As Kering's share price has dropped by 8% this year, investors are increasingly skeptical about the company's ability to recover from several quarters of disappointing sales. However, the recent appointment of Luca de Meo, a veteran from the automotive industry, as the new Group CEO has sparked some optimism. His leadership is set to officially begin on September 15th. Carol Maggio, who leads European luxury goods research at Barclays, noted that De Meo has a proven track record in revitalizing businesses and enhancing brand appeal. Nevertheless, he faces a daunting challenge, especially with the looming threat of new 15% tariffs on imports to the US, and growing concerns regarding consumer spending, particularly in the crucial Chinese market. Amel Poulou, Kering's chief financial officer, mentioned that the anticipated tariff rate aligns with their expectations and can be managed through strategic pricing adjustments. She indicated that the company has already implemented some price increases in the second quarter and is considering a second wave of hikes in the autumn, all while being mindful of consumer sentiment. Despite these pricing strategies, analysts believe that the more significant challenge lies in restoring the brand's image and desirability, especially under the guidance of Gucci's new artistic director, Demna Gvasalia. Francesca Bellatini, Kering's deputy CEO and head of brand development, revealed that a glimpse of Gvasalia's vision for Gucci will be unveiled in September, with a full collection rollout expected in early 2026. Tang emphasized that the issue of product desirability Maggio added that introducing fresh and innovative designs could be the key to revitalizing Gucci's appeal. As the luxury market continues to evolve, the question remains, can Kering successfully navigate these turbulent waters and restore Gucci to its former glory? What are your thoughts on the challenges facing Kering and its brands? Share your opinions in the comments below. Gucci sales plummet 25%. What's behind the luxury brand's design dilemma? As Kering embarks on its second design overhaul, Gucci's sales plunge signals a broader shift in consumer behavior. Revenue at the Italian label dropped 25% in the second quarter, matching analysts' estimates, while overall sales fell 15%, aligned with expectations. However, this decline may reflect a growing concern over how brands are adapting to evolving consumer preferences and shifting industry dynamics. But here's where it gets controversial. Meanwhile, critics argue that such changes could disrupt global fashion supply chains,